Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be analyzing my favorite company. And well, you're going to see exactly why it's my favorite when we go through the fundamentals, but man, when I actually show you guys what would have actually happened if you would have bought this company a couple of years ago and how much in dividends you would get, you would be flabbergasted by it because, well, it's kind of ridiculous as to how much in dividends these people actually pay. But nonetheless guys, let's actually analyze this company using discounted free cash flow, and of course seeing that their earnings is actually coming up tomorrow guys, on Thursday after close, which by the way we will be doing an analysis on their report because I am very interested in this company. Because I really would like if this thing were to fall a little bit more if possible. So seeing that, again, we're going to be analyzing their earnings report tomorrow as well. But today, let's actually see what we can actually find out when it comes to the company Broadcom. So with that said, let's get started with this analysis. Now guys, before we actually move on to the dividend summary, let's actually see what this share price actually is. So as you can see, today was down $499.11, down 1.44%, and aftermarket it went another 1.112% down to $493. But what I'm more interested guys is in this 52-week range. Take a look at this price guys, $677.76 at the peak. Why is this important? Well, let's actually now go into the dividend summary, and we can actually see guys that they do pay a pretty big dividend at 3.24%. And you're probably saying we have seen bigger ones. Yeah, except that this one guys per share pays out $4.10 per share. This ends up being an annual payout of $16.40. Massive dividends. So let's actually come back here guys to the share price really quick because I want to show all of you guys something very cool. So if we come over here to the advanced and we go over here to, let's just go to the 5-year view, and if we zoom in during when COVID was happening, which was at around like here, take a look at this guys. The price that AVGO was at that time was $195 roughly, right? Give or take, let's just say 190, 193. That is absolutely insane. Imagine buying this company with a massive dividend yield of significantly higher than 3.24%, but having guys an annual payout of $16.40 for $193. And on top of that guys, remember, you would have also gotten a massive run up when it came to this company's just capital appreciation, going from $193 all the way up to again $677. So on top of a massive dividend that you would have probably kept till today, you would have gotten a massive run up from $193 to $677. So this is one of the main reasons why I absolutely adore this company. If this thing were to ever fall down to like, let's just say $200, oh my God, the possibility of this company's just massive possible run up as well as a massive dividend like this, it would just be absolute insanity for me. I would really love for this thing to fall significantly, hopefully in the future. But let's actually see if this dividend is sustainable. Now we do see that the payout ratio is 49.33%. We're going to take a look at the payout ratio in regards to the cash flow in just one second. This one doesn't tell us the whole story, but it is a good stepping stone. Now take a look at this 5-year CAGR guys. The 5-year growth rate on this dividend, it is a whopping 34.82%. This means that within the past 5 years, they have grown this dividend at essentially 35%, right? That is massive. And on top of that, they haven't just been growing this dividend for like a couple months or like a year or two. No, they've actually grown it for like 10 consecutive years. That's not too shabby either. So all in all guys, this doesn't seem to be like a really bad dividend. Now coming to their ex-dividend date, unfortunately it did pass as of June 21st. Payout date was June 30th, and of course they pay their dividends quarterly. But take a look at this guys, even though this ex and payout date already passed, well, the fact that they were in June, September is coming up, so you can pretty much extrapolate that it'll be at around like the same time in September. So with all of that said guys, you can see that I really like this company, but let's actually go into the fundamentals because they're not too shabby either. Ticker symbol of AVGO, market cap of $201.5 billion with a PE of 24.73. Now, this is telling me that with a current share price of $499.11, obviously it is lower now. Google Finance doesn't take post-market, but this pretty much is telling me that it is a little bit expensive right now, even at $499. We're going to use this kind of free cash flow to see what we should be actually paying for this company. Now, looking at this dividend, we want to see if this is sustainable, guys. Well, annual dividends per share, as we just saw, $16.40. Amounts paid in dividends every single year is $6.6 billion. Looking at their 5-year average free cash flow and subtracting this $6.6 billion from the 5-year average, we get around $3 billion. And looking at their last year's free cash flow, they still have $6.7 billion or so left as of last year's free cash flow. So pretty big numbers. However, well, this is where something doesn't necessarily look too good. And if we take a look at the payout ratios in regards to this, we can see that for the last year's free cash flow, it is at 49.98%. So, okay, that was good. It's below my 60% mark. However, the 5-year average, guys, it is 69.49%. Now, that is significantly higher than what my margin of safety for this payout ratio for the cash flow is. However, when you guys see this cash flow, you're going to be like, okay, I understand why I don't really pay this any mind, because it does seem bad, but if you see the previous free cash flows, it's actually not too bad as it seems. But anyways, let's move on to the fundamentals. Now let us begin, guys, with the fundamentals. So, of course, with the net income of 5 years ago of essentially $1.7 billion to 1 year ago of $6.7 billion. That is an increase of 298% on the 5-year. Now, the main issue with this graph, guys, it is that, well, we have a massive outlier 4 years ago where they did $12.3 billion. Now, this is a little bit concerning, but guys, it was essentially just 1 year, and ever since then, from 5 to 3 to 2, so even during COVID to 1 year ago, they have been increasing this. However, I cannot give a perfect score when it comes to this. In fact, I'm gonna have to give it not the best score because of the fact that we do have this massive outlier and that their increases aren't that necessarily that good. So I'm actually gonna go, guys, with a grade of around like a 50%. Now taking a look, guys, at the free cash flow, the most important of all the profit metrics, cash from operations less your capital expenditures. The reason why this is the most important one is because this is what sustains that dividend. This is what sustains share buybacks. This is what helps pay down debt. This is also what helps a company make acquisitions, which I believe AVGO did make an acquisition a couple weeks ago. And yes, they actually are trying to acquire, guys, VMware. So yeah, that is essentially what this cash flow even goes into going, guys, to making acquisitions as well. So very important for this thing to, of course, be increasing as well as just being positive in general. Now, guys, this is a massive increase, as well as very consistent. We got 5 years ago of $5.5 billion to 1 year ago, guys, of $13.3 billion. That is a massive increase, guys, of 143% with a 5-year average of $9.6 billion. So when we were looking at the payout ratio in regards to the 5-year average free cash flow, it was pretty high at around like 70%, right? But I said it's not that bad because of the free cash flow, and this is the reason why. Take a look at this, guys. From 5 to 4 to 3 to 2 to 1 year ago, it has been consistently increasing year over year. There hasn't been one instance where it was an outlier year. There hasn't been one instance where, oh, they just did like a dip. Even during COVID, nothing. It has been very consistently increasing within the past 5 years. So the likelihood of this continuing, well, it's actually fairly high. Does this mean that this year they won't dip a little bit? No, absolutely not. But the fact that it has been in the past 5 years consistently increasing gives you credence that they might continue to do that. Guys, this is a perfect score. I cannot give this anything less than a 100% because, well, it's perfectly increasing as well as is positive. This is essentially why I absolutely do not believe that that payout ratio of 70% on the 5-year average is too much of a big deal, because if they continue this trend, well, that's not necessarily going to be an issue in the future. Now looking at the revenue, we got 5 years ago of $17.6 billion to 1 year ago of $27.45 billion, increase of 55.65%. And guys, this is another very good good looking metric. Every single year, consistently increasing. It is pretty much staircasing. Now we do see a little bit of a jump here from 2 years ago to 1 year ago, going from 23.8, essentially 24 billion to then 27.45, but it's not a massive outlier either. You could just essentially attribute this to like inflation, right? Products cost more, therefore the revenue is going to go up. But that's about it. Overall, guys, I'm going to give this once again a 100%. This is an absolutely gorgeous metric. So when it comes to the profits, the only one that is iffy, guys, it is the net income. Aside from that, cash flow and the revenue, golden. Looking now at the balance sheet numbers of assets minus liabilities, let us find out, guys, if maybe, hopefully, their assets do end up covering their liabilities. Because if they don't, then we have a bigger problem, because this means that the company could actually go bankrupt. Now, this is fairly interesting because of today, they almost have $21 billion. However, if you take a look at this graph, guys, it's kind of downtrending, which is a little bit concerning. Now, they have been in the positive. There hasn't been a single year where they have been essentially below zero. They've been in the negative, but nonetheless, it is still decreasing. So I can't give this a really good grade just because of that reason. And on top of that, guys, their year actually ends in November. So I highly doubt that they'll be able to make another, what, $3 billion in assets minus liabilities as of this year. So again, unfortunately, I think this will end up being lower than that of 1 year ago. Average total assets, we get around $65.8 billion. Average liabilities, we get $41.7 billion. And doing this difference, we get around $24.1 billion. Guys, I actually have to give this a really low score. Unfortunately, I have to give this at like around like a 50%, maybe even 45. I'm gonna go with 50. Just because, well, it is downtrending. You know what? No, I'm gonna go with 45. Just because it is downtrending, guys, and that's unfortunate. It really is. But yeah, it's downtrending. It's still in the positive, but it's downtrending. What more do you want me to say? So I'm gonna give it, guys, essentially like a 45%. Now looking at the cash flow minus liabilities, as I said when we were doing cash flow, it is a metric that can be used to essentially pay down their debts, which is part of their liabilities. So let's take the cash flow year over year, which we saw that it has been consistently increasing, and subtract the liabilities from it. Now, what we can see here is that, well, it's actually the liabilities that is increasing, not so much the assets or the cash flow, right? The liabilities are significantly increasing faster because as of 1 year ago, they're in negative $37.3 billion. And within the past 5 years, again, massive decrease as well, further into the negatives. Now, we do see a little bit of trend that they might be able to cover this a little bit better, that their liabilities are decreasing, or the fact that their cash flow is also increasing. You can see from 5 to 4 years ago, big jump to negative $15.2 billion, but after that, guys, they brought it back down again to negative $33.3 billion. Then during COVID, they brought it back down again to negative 40. So their liabilities significantly increased because in this scenario, we saw that the cash flow was increasing as well. So the fact that this is going lower is because of the fact that they're taking on more liabilities. But ever since then, guys, as of last year, they have been increasing a little bit from negative $40.4 billion to negative $37.26 billion. So that is what it is. Now, average cash flow minus the average liabilities, we get around negative $30.4 billion. I'm going to give this, guys, essentially like a 65% because, well, okay, it is getting further into the red, but we do have instances even closer to today that they are at least able to get this closer and closer to zero. So that's essentially why I'm giving it 65%. Now looking at the shares outstanding, the most underrated of all the metrics, because this is the one that tells you guys if the company is diluting you as the investor. And on top of that, when a company pays out a massive dividend like this one, well, the more shares that they have outstanding, it actually makes it worse for them because that just means that that's more shares that they have to pay a dividend for. So it's not good for a company to be issuing shares when they pay out a massive dividend like this. Now, when it comes to this company, they are buying back shares, but it's not as I would like it to be. We got 5 years ago 409 million shares to today of 406 million shares. Now that is on the 5 year a decrease of around 0.75%. And from the previous to the current year, they have bought back around 1.7%. This is looking at 1 year ago of 413 million to today of 406 million. Now, the reason why this actually doesn't impress me too much is because, first of all, on the 5-year, it's not that big of a decrease. And on top of that, guys, we can essentially see that from 3 years ago to 2 years ago, and then from 2 years ago to 1 year ago, they were consistently increasing. Their lowest, guys, was 398 million shares. So the fact that they increased it from 3 to 1 year ago, it is not good. But you could pretty much attribute this to COVID, because the following year, as of today, there are 406 million shares. So you know what? At least they are keeping it around this average at around like 400 million shares, 405 million shares. So it's not too bad. I just wish that the decrease was a whole lot more stronger, right? Much more aggressive. So for that reason, guys, it is a decrease. So I have to give it the minimum of 70%. But that's as much as I can go at around 70%, just because it is not that aggressive as I would like it to be. And now lastly, when it comes to their cash and equivalents, they currently have $9 billion with an average of $8.22 billion. So now, guys, let's take a look at this overall grade. We can see that their net income, we gave it a 50%. Free cash flow, 100%, as well as the revenue. Guys, these metrics are perfect. They're absolutely perfect and gorgeous, and I love it. So right then and there, we got the most important of the profit metrics, as well as the revenue, which is on par with that of the net income when it comes to weight, at a perfect score. This is going to bring up this grade a lot. Now, when it comes to the assets minus liabilities, give it a 45%. It wasn't that good, right? It's decreasing, unfortunately. It is positive, but it is decreasing, so I don't necessarily like that. And when it came to the cash flow minus liabilities, we gave it a 65%, just because of the fact that, okay, they are getting lower as well, but you can see instances that they are getting a little bit better. And lastly, shares outstanding, 70%. They're keeping it the same, but overall they have been decreasing it. This gives it a final grade, guys, of 77%. This is the reason why I absolutely love this company, because all they have to do, it is just fix this net income and essentially just fix their liabilities and assets, and that's about it. With those two alone, you will get this at an 80. And if they do a pretty good share buyback, guys, there it is. That is pretty much going to make this like an 85 or 90% company. So let us come over here and make some assumptions, because I am very interested to see what this calculator says. Because if this thing says that it is a good buy right now, whoo boy. Though to be fair, at the base price, we can see that it doesn't get above $404.08 for the target share price, not adjusting for debt, and $351.24 adjusting for debt. So don't expect this thing to be a good buy today. But nonetheless, guys, let's come over here to Seeking Alpha's growth tab. We can see that the revenue growth forward is 13.29%, and the revenue growth year over year is 17.38%. Now, do I believe that this will happen? I don't necessarily know, guys. We have seen a lot of cracks when it comes to the chip sector, and you know, Intel, AMD, QCOM, all of them are showing that it is slowing down. So I'm actually going to be very, very conservative when it comes to this. And you may disagree with my numbers. We'll revisit this when their earnings report comes out, and I'll change it appropriately. But guys, I'm going to go for the low assumption of 5%. Revenue growth for the median, let us go to around 7%. And for the highest assumption, let us go at around 9%. Now for the projected share buyback. Well, here's the thing with that, right? Within the past 5 years, they did what, 0.75%? I don't know. I personally don't know. A bill just became law that essentially made a massive tax of 1% added to share buybacks when it comes to companies. So unfortunately, that is not good. Maybe they'll keep it roughly the same, or maybe they may issue a little bit of shares here and there, especially if they see that their cash flow might go up. But I don't think that they'll do anything higher than like 1% at the peak. So let's go with 0% for the projected share buyback for the low assumption. Let's say 0.5% for the median assumption, and let's go with 1% at the highest assumption. Guys, this gives us some target share prices. We got, not adjusting for debt, for the low assumption of $481.88, median assumption $518.67, and for the highest assumption $557.71. Adjusting for debt, you can see they do have a lot more net debt on hand than they do cash and equivalents, which brings this value down. Now for the low assumption, guys, it is $429.03. Median, it is $465.56, and a high one of $504.33. Adding margin of safety of 5, 10, and 50% on top of this target share price adjusting for debt. This puts me between the buy ranges of $364.68 to $407.58. For the median assumption, it is $395.73 to $442.28. And for the highest assumption, it is $428.68 to $479.11. Guys, the current share price is $499. Now, post-market, it is $493. So at that point, we are essentially between the target share prices adjusting for debt of the median and the high one. So it really just depends as to what you believe these revenue growth guys are going to be. Me personally, I am comfortable buying this. I kid you not, I am comfortable buying this at around like the $565 range. You know, I would prefer it to go down to $395. If it goes sub 400, oh dear lord. But I'm perfectly comfortable buying this from like 465 to like 479 or 481, right? Between 465 and 481, I'm like, okay, I'm pretty comfortable buying at that point. But aside from that, I still think that 499, guys, is still way too much for me, even though I absolutely adore this company. But like I always say in every single video, guys, this is not financial advice. I just gave you guys my opinion, and even these up here, these revenue growth assumptions, right, and predicted share buyback assumptions is based off of what I believe this company will do in the future. Since every investment is the present value of all future cash flow, I highly suggest that everybody gets this calculator. The link is in the description of this video to another video that consolidates all the calculators. And in that video, there are links in that description that brings you to all of the spreadsheets. So please have all of them, have discounted free cash flow, as well as the weighted grade as well. I also have available for you guys the book value for companies that don't have cash flow, or just banks in general that are just better suited for book value, re-evaluation calculators for REIT companies, and even, guys, a dividend tracking sheet. If you guys don't believe I actually hold this company, let me actually bring you guys all the way over here to show you guys that right here I actually do own Broadcom. Not a lot of it, I own around 8.22 shares, but you know, I still own a little bit of it. They do pay me quarterly of around $33.74, so it's not too shabby. Now, as you can see, I am down as of buying this $345.50 because, well, I originally bought this when the price was around like $550. So yeah, I bought this before I even made this calculator, so that essentially shows as to why I'm down $345. But nonetheless, I mainly care about this sweet dividend of $33.74. So guys, that just goes to show that when you overpay for something, you will get screwed over, right? You don't want to overpay for growth. You want to be aware as to how much a company's value is worth based off of their revenue growth and, of course, their free cash flow. So again, please have this calculator, make your own assumptions, and all I'm asking for in return, guys, is just help me grow my channel. We are so close to 1,000 subscribers, it's not even funny. If we could reach that by the end of September, that would be amazing. That would absolutely be amazing. Thank you all so much for everybody who have subscribed. I really do appreciate it. It really does motivate me to make these videos. Labor Day is coming up, guys, Labor Day weekend, so I will be doing a whole lot of videos. I'll try to catch up to all of your recommendations, and I'll put them sporadically throughout that week. So yeah, it really does motivate me, guys. Just keep going. I mean, as I'm recording this, it is 958 subscribers. You're all crazy, and I love it because I never thought that I would reach like 500, let alone almost 1,000 at this point. So thank you all so much, guys. I really do appreciate it. At 1,000 subscribers, I do plan on making a very special video, and maybe even a part 2 to that of like an AMA or something. So again, thank you all so much. I really do appreciate it. Have these calculators as well as free content as well. Now let us come, guys, to the dividends at the current share price. If you guys are interested in this dividend like I am, let's actually find out how much you would get if you were to put in 1 month's income at the average US income at $68,703, how much you would get in dividends annually, quarterly, and monthly. Now, if we were to do this, this would buy you guys 11.47 shares, which at the current annual dividends per share would essentially get you annually $188.12, quarterly of $47.03, and monthly at $15.68. So unfortunately, it is not at the $200 mark that I like, but let's actually change this up a little bit. Let's come over here and let us put in around like 470, right? Let's put in a share price of around $477, and now let's see how much this dividend has grown, guys. Now, it didn't reach the $200 mark, but now it is $196 in annual dividends, quarterly of $49.21, and a monthly of $16.40. Now I am actually very curious about something. At the beginning of the video, I showed all of you guys the lowest that this company was at during COVID of $193. Guys, if they were to have kept that same dividend at $16.40, and they were at that share price of, like, let's say $193, oh my god. Take a look at this, guys. Look at that annual dividends. $486.50, quarterly of $121.62, and a monthly of $40.54. Yeah, guys, this is why I really want this thing to fall, because if it falls, I don't think it'll fall to that amount again, but if it does by some miracle, oh my god, think about increasing your annual income by almost $500. That is insane, just from one company. Oh dear lord. So I really do hope that this does happen. Will it happen? I don't think so, but you know what, I'm gonna dollar cost average on the way down if this thing goes sub 400 in the future, because that is just way too good to not do, guys. All in all, when it comes to AVGO, as I said, I love this company. This is my baby. This is one of my babies, right? My main baby would be like Microsoft, but AVGO, guys, when I saw this company post COVID, and I was just like, a $16.40 dividend, and this thing was $193, and I didn't know about it. What was I doing with my life? I felt like the biggest. It felt like the biggest kick to the rear end. I was just like, oh my god, what did I do? And then I started looking at like the fundamentals and all the stuff, and I'm like, I just wow, what did I just do? So now I'm really hoping for this thing to crash and fall, because it's looking good. So that's pretty much all I want to talk about in this video. Tomorrow we will take a look at their earnings report. Be on the lookout for that the same day. So, you know, I really want to put out that video the same day as well. But yeah, guys, that pretty much is it for this one. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, guys, peace out, and be on the lookout for the next stock analysis video.